What if I told you there's a company that controls 21,000 miles of steel stretching across the eastern United States, touching 23 states, 70-plus deep-water ports, and carrying everything from chemicals to coal to consumer goods?
And right now, they're running one of the most aggressive margin expansion plays in the entire industrial sector. 200 to 300 basis points of improvement. And a CEO who's done it before.
Welcome to Charged Alpha, episode 140. I'm Hudson Thomas, alongside Lana Chen, and today we're going deep on CSX Corporation, ticker CSX. Let's get into it. CSX Corporation, founded in 1980, headquartered in Jacksonville, Florida. They're a Class 1 railroad, one of the big 7 freight railroads in North America. About 23,500 employees, running one of only 2 major rail networks east of the Mississippi.
That geographic distinction is the whole story. Roughly 2/3 of the U.S. population lives in CSX's service territory. They're not just moving freight, they're a critical logistics artery for the Eastern economy.
Revenue-wise, they pulled in $14.1 billion in fiscal 2025 across 4 main segments. Merchandise is the heavyweight at $8.8 billion. Chemicals, automotive, agriculture, metals, forest products, then coal services around $2 billion, intermodal another $2 billion, and trucking at $844 million.
The moat is structural and irreplaceable. You cannot build a competing 21,000-mile rail network. The regulatory barriers alone would take decades, and the capital required runs into the hundreds of billions.
And the timing right now is fascinating. CSX is guiding for major margin expansion, projecting 50% or more free cash flow growth, and the Howard Street Tunnel project enables double-stack intermodal containers along the I-95 corridor.
Plus, Q1 earnings drop on April 22nd, literally a week away. The Street is watching this one closely.
So there's a lot of pieces in motion. Let's start with who's driving all of this. Steve Angel took over as president and CEO in September 2025, so about 7 months at the helm. But this is not your average new CEO learning curve.
Definitely not. Before CSX, Angel ran Linde, the world's largest industrial gases company. He oversaw the $45 billion Praxair-Linde merger and delivered 219% shareholder returns during his tenure.
And before that, 17 years at Praxair, where he generated 257% returns as chairman and CEO. He started with a 22-year career at General Electric, including direct locomotive and rail operations experience.
So he literally has hands-on railroad experience from early in his career, combined with decades of proven execution at the C-suite level. That's a rare combination.
The man said he flunked retirement. He's 70 years old with 45-plus years in industrials, and he chose to come run a railroad. When someone with that track record picks your company, it tells you something about the opportunity.
Let's get into the financials. CSX trades at $42.32, putting the market cap at $78.7 billion. Trailing PE is 22.97. Forward PE drops to 19.43.
That forward compression is pretty meaningful.
It is. That spread tells you the Street expects significant earnings growth ahead. The 2026 consensus EPS estimate is $1.86, roughly 21% above the trailing number of $1.53.
And the stock's been moving, up 29% year-to-date, outpacing Union Pacific at about 8%.
Revenue for trailing 12 months was $14.12 billion. But full year 2025 actually declined about 3%, which is worth flagging. The growth story here isn't about top line. It's about what they're doing with margin and cash flow.
Walk us through that margin picture.
Operating margin sits at 31.6%, already strong for a railroad. Management is guiding for 200 to 300 basis points of expansion through over 100 discrete cost-saving initiatives. Operating cash flow was $4.6 billion, free cash flow $1.7 billion. With CapEx dropping below $2.4 billion, they're guiding for 50% or more FCF growth.
So less spending, more cash coming out the other side.
Exactly. Return on equity is 22.6%. Dividend yield is 1.28% with a 34% payout ratio, conservative and sustainable. Now, the balance sheet carries $18.6 billion in debt against only $670 million in cash.
That's a lot of leverage.
It is, but it's typical for capital-intensive railroads. The current ratio is below 1, which signals near-term liquidity tightness. The key metric is whether free cash flow growth materializes, because that's what services the debt and funds shareholder returns.
And the gross margin?
Around 42.5%. With EV to EBIT at 13 times, the valuation is in line with the sector, but predicated on margin execution. Overall, CSX's financial health is solid. Strong margins and improving cash flow generation offset by meaningful leverage and volume uncertainty.
46 analysts cover CSX. That's heavy coverage for a railroad. What's the breakdown?
Consensus is buy. 28 buys, 17 holds, just one sell. Average price target is $39.08, which is actually below the current stock price at $42.32.
So the stock has run past the consensus. Are analysts catching up?
Some are. Wolf Research has outperformed with a $46 target, citing rising U.S. chemical rail carloads, up 3.3% in early 2026. Stevens went overweight with the highest target on the street at $47, driven by cost initiative conviction. RBC Capital has outperformed at 43, focused on intermodal growth.
And the last earnings report.
Q4 2025 reported in February. Revenue came in at $3.51 billion, down about 1% year over year. They missed on both revenue and EPS, which wasn't great. But the forward guidance, margin expansion, FCF growth, is what got the street excited.
Classic miss the quarter, guide up the year playbook.
And the market bought it. The stock ripped from the low 30s to the low 40s in about 6 weeks.
Bull case first. The margin story is the headline. 200 to 300 basis points of expansion is ambitious but credible when your CEO has done this at Linde and Praxair. Over 100 cost initiatives are in flight, CapEx is declining, and the Howard Street Tunnel unlocks a completely new intermodal growth lane along the East Coast.
Don't forget the pricing power. CSX has been driving 18 to 50% average revenue per unit increases across commodity groups over the last 3 years. In a duopoly market, that pricing sticks.
And free cash flow growth of 50% plus gives them ammunition for dividends, buybacks, and debt reduction. The new CEO is a capital allocation machine.
The bear case is execution risk at the top of a valuation range. CSX trades near its 52-week high of $43.35, and the consensus target is below the current price. Revenue declined 3% last year, and flat industrial production doesn't give you much organic volume growth.
So all the growth has to come from the cost side?
Essentially, yes. If those 100-plus initiatives underdeliver, you've got a 23 times earnings stock with $18.6 billion in debt and a current ratio below 1. And there's the competitive wild card. Union Pacific's proposed $85 billion acquisition of Norfolk Southern would fundamentally reshape Eastern rail dynamics.
If that goes through, CSX could go from duopoly to facing a much larger competitor.
Right. CSX has floated a virtual merger concept with BNSF as an alternative, but that's still very early stage.
Let's stack CSX against the other major rails: Union Pacific, Norfolk Southern, and Canadian National.
Union Pacific is the revenue king at $24.5 billion. They trade at 20.55 times earnings, cheaper than CSX's 2023, with the strongest margins in the group. Norfolk Southern trades around 25 times, similar to CSX, with a hold consensus amid takeover speculation.
And Canadian National.
The value play at 19.86 times earnings with cross-border Canada-US exposure. Flat volume growth expected, but the lowest valuation multiple.
So CSX sits at the premium end of the group.
It does. The premium is justified if the margin expansion delivers. If it doesn't, CSX looks expensive relative to UMP and CNI. That's the key question for anyone looking at this stock.
Let's check the options market. What's the positioning telling us?
Put-call ratio around 0.85, modestly bullish. Implied volatility percentile is only 35, which is quite low. The options market isn't pricing in a big move despite earnings being a week away.
Where are the clusters?
Call open interest at $45 and $50 strikes, aligning with the bullish analyst targets. Put activity at 40 and 35. Market rebellion flagged increasing unusual put volume in early April, likely hedging ahead of April 22nd.
Pre-earnings insurance buying. Pretty standard for a stock sitting near highs. Insider activity is a mixed picture. CEO Steve Angel purchased 80,000 shares in 2 transactions, October and March, totaling over $1 million. That's a meaningful buy from the new chief.
On the flip side, 5 insider sales totaling about 188,000 shares worth over $7 million. The chief accounting officer and an EVP were the primary sellers. Net, more selling than buying by volume.
The CEO buying is the signal I'd weight most heavily. He's putting his own money behind the turnaround he's leading.
Agreed, but the broader C-suite selling suggests cautious optimism rather than universal conviction. Worth monitoring.
Key risks on the radar. Industrial softness continues. Housing, auto, and chemicals are all dragging volumes. That $18 billion debt load needs attention.
Volume headwinds from flat industrial production are real. There's negative revenue mix risk. If growth tilts toward lower margin bulk commodities, yield gains get limited. And the UP Norfolk Southern merger uncertainty hangs over the entire Eastern rail landscape.
Forward catalysts to watch.
Q1 earnings on April 22nd is the immediate one. Then operating margin progression through the year. We'll know by Q2 results if the cost initiatives are tracking, and any updates on Howard Street Tunnel completion timelines.
Bringing it all together, CSX Corporation.
An irreplaceable Eastern U.S. rail network, a new CEO with a proven track record of massive shareholder value creation, an aggressive margin expansion playbook targeting 200 to 300 basis points. The stock has run hard, up 29% year to date, and trades at a premium to most peers. The key metric to watch is operating margin progression. If CSX delivers, the forward PE of 19 looks reasonable. If they don't, there's not much margin of safety at $42.
The rails have been running for almost 2 centuries in this country. CSX is betting they can make the next chapter the most profitable one yet. Ralph Waldo Emerson once wrote, "Railroad iron is a magician's rod in its power to evoke the sleeping energies of land and water."
Written in the 1850s and still perfectly relevant. Rail infrastructure remains one of the most capital-efficient ways to move goods across a continent.
Love it. That's going to do it for episode 140 of Charged Alpha, our deep dive into CSX Corporation. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.